Somebody once told me the world is gonna roll me. I ain't the sharpest tool in the shed. She was looking kind of dumb with her finger and her thumb in the shape of an L on her forehead. Well, the years start coming and they don't stop coming. Fed to the rules and I hit the ground running. Didn't make sense not to live for fun. Your brain gets smart but your head gets dumb. So much to do, so much to see. So what's wrong with taking the back streets? You'll never know if you don't go. You'll never shine if you don't glow. Hey now, you're an all-star.
Woo! We are back. Episode 43, True North. We have got a great show for you tonight, and I'm going to be hosting. Jeff is in the building. For some reason, he was adulting today or something, and asked me to do it. I guess he kind of assumes since I have no job that I got nothing else to do. Kind of rude, to be honest. But we also have Tim Kotzman. We got Mike. We got Dan in the house. We've got a great agenda for you. We are going to be covering S&P ratings, whether they're good, bad, or indifferent. We got labor, we got layoffs, we got macro tailwinds, we got the 4-year cycle fallacy, we got the 5 pillars of Bitcoin treasury companies. But we will go ahead and kick it off with leverage as per usual, and then get into underwriting Bitcoin risk probably. So Jeff is already sharing. So
Boom.
Take it away.
Let's get into it. Yes, episode 43. Thanks for kicking us off, Soleil. As usual, we start off with the leverage update and we jump into the amount of Bitcoin held. Actually, before that, let's kick it over to Tim for not financial advice.
Right.
Because none of this
I almost interrupted. I was going to say,
Yeah.
I was going to interrupt and say, Jeff, can you really talk about leverage without saying, ladies and gentlemen, what you're about to hear might be interesting, but it's not financial advice.
The host working for free is overpaid, apparently.
It's for entertainment and informational purposes only. Back to you, Jeff.
Thanks, Tim.
Bingo. Okay, and for those that are new here, this is True North, the investment grade Bitcoin podcast. We're here talking about strategy. We're talking about Bitcoin treasury companies. We're talking about securitization of Bitcoin, how this market space is evolving. We talk about digital credit. We talk about leverage. We talk about business models, architecture of markets, macro, and we try to hit everything under the sun. Obviously, there's so many things going on here. We could talk about we could talk for hours on each one of these individual topics. So we're just trying to hit the high level stuff as quickly as possible and get into some deep thoughts on the market space here. So we kick off every week with the financial leverage. So looking at strategies of leverage, how it's changed over time, and to really showcase the strength of the balance sheet here. So the strategy holds 640,808 Bitcoin. I think they added somewhere around 300 Bitcoin this last week, purely from perpetual preferred equity issuance. The price of Bitcoin, as I made this, was about 110,400. Looks like it's still about there. My strategy price is $275. Bitcoin assets held on balance sheet. So they've got $70.8 billion of assets held on balance sheet, $8.2 billion of debt, notional preferred equity around $6.6 billion. So their net capital, their assets minus the debt, is about $62 billion. Annual dividend liabilities around $643 million. So the years of dividend coverage that they've got on their balance sheet is about 110 years of dividend coverage, just taking the net capital divided by the annual dividend liability. So really, this is financial strength. Liability to asset leverage, liability to asset ratio, thinking about total leverage, they're around 21%. Again, I think strategy is now calling this amplification because the preferred equity on their balance sheet is equity. It's not debt. There's not a maturity. So it can be treated a little bit differently when you're thinking about leverage. The total debt coverage multiple is about 4.8. Looking on an as-if basis, if you pull the debt that's trading as equity off the balance sheet, you're looking at a 16.8% amplification ratio and a debt coverage multiple ratio of 6.0. So when thinking about, what would the price of Bitcoin need to go down to for this business model to start to become a little bit concerning, the Bitcoin price would need to be less than $23,207 for the assets to be worth less than the notional debt and the preferred equity on the balance sheet. Again, that's pretty far away. We haven't seen a price of $23,000 since November of 2023. What was that? November of 2022. Actually, it's been quite a while. Actually, yeah, about December of 2022. So, yeah, I think that the balance sheet looks incredibly strong here, and this is balance sheet finance. It's blowing people's brains a little bit, trying to wrap their head around utilizing this collateral for cash flow. I think they're doing this very efficiently, and they're growing that model into the future using digital credit, which we'll dive into a bit more. When you think about the ability to withstand shocks on the balance sheet, the balance sheet is actually still very strong. If the price of Bitcoin were to drop 50% here, Strategy would have $35 billion of assets on the balance sheet, and not changing any of the debt or preferred equity figures. They would then have 55 years of dividend coverage. So when you're thinking about downside risk of the perpetual preferred equity, these things look incredibly strong from an over collateralization perspective when you're looking at the ability to pay dividends, not necessarily notional repayment, but the ability to pay dividends. We can get into the S&P perspective there, but maybe I'll kick it back to you, Soleil.
Yeah, I mean, I think the leverage, there's been some comments like, oh, we talk about the leverage every time and it doesn't matter. We just want to talk about when number go up. But this is going to become very important when we talk about, or when you talk about underwriting Bitcoin risk, but then also like the JP Morgan thing that we'll discuss later. So, I mean, if we don't have anything more to talk about leverage now, you want to just move on to underwriting Bitcoin?
Yeah. So there's a couple. Maybe we start with S&P.
Okay. Ratings.
Maybe we start with the S&P, the ratings, and we'll start there because then we'll get into underwriting Bitcoin. We'll get into underwriting the other instruments. But right. So Strategy. Let me just stop sharing my screen. There we go. We got Tim front and center. This is great. So Strategy was just rated. They got an issuer credit rating of B- recently, earlier this week. And the irony here is Strategy got a B- issuer credit rating within days after JP Morgan said that they are accepting Bitcoin as collateral. Total irony. The irony is the S&P, when they put out their ratings framework, gave zero credit for the Bitcoin capital held on their balance sheet. Zero. So that the $70 billion that we just walked through, the assets held on balance sheet, they gave zero credit for.
Zero.
Yet the largest bank in the world, JP Morgan, is now accepting Bitcoin as collateral for loans. So there's just a disconnect between the S&P and what some larger banking institutions are starting to see. Now, I think this is some really, really downstream implications. I think the reason that they were, and I'm totally speculating, I think one of the reasons that Strategy was given a B- rating was because the yield that they have on the instruments that they're offering to the market is in line with other B- entities. So if they were to give Strategy a rating higher than that, you then have to question the ratings framework, the entire ratings framework. Why is this product that's paying a 12% effective yield have an issuer credit rating higher than all of the other like high yield instruments in the market, yet the yields are the same? It starts to break the perspective of all of the other instruments in the market. And then you start to look at the other, maybe investment grade products in the market that are paying, 6, 7, 8% effective yields, and they're not super over collateralized. Basically, the only way that the S&P was able to really back into the B- credit rating was giving 0% credit to the Bitcoin as capital on the balance sheet. I think we all agree that the amount of credit that Bitcoin should be given is greater than zero. And if you give greater than zero credit, the rating goes higher, right? Like the rating absolutely goes higher. Just to put this into perspective, real estate, when held on balance sheet, is given 89% credit as capital. Bitcoin gets 0 credit. Real estate gets 89% credit. Big difference. So, and the fascinating part here is just doing some research. Like global real estate, I think average daily volume of global real estate is like $2 billion ish, maybe a little bit higher. Average daily volume of Bitcoin is $50 billion. So if you think about liquidity profile, which capital is more, which is a better form of capital, probably the more liquid one. And then you think about real estate again. Real estate is just regionally liquid, and Bitcoin is globally liquid. You can pick it up and you can move it anywhere. Okay, so you now got 2 better check marks for Bitcoin over real estate. How often, how many days a week, like, can you liquidate real estate at 12 o'clock p.m. at night? No. So you've got some discrepancies that I think are really hard to ignore when you're looking at how to rate these particular companies.
Yeah, and I know some people are annoyed every time we say we're still early. It's like the battle cry. But if players this large are still fighting about whether Bitcoin is worth anything, that's not like late S-curve adoption. That's got to be early S-curve if there's still a battle about this thing.
Yeah. The other, I think reading the filing from the S&P is really fascinating too. The other thing that was interesting is that the convertible debt maturities did weigh on the rating. Not necessarily the preferred equity, but the convertible debt in particular. And it was the verbiage around it. I think it was the convertible debt has more liquidity risk, and the preferred equity has some liquidity risk. So just emphasizing that there's a different perspective of having this maturity at a future point in time on your balance sheet, as opposed to not having a maturity on your balance sheet as a future point in time. So you've got a whole different liquidity profile in the future. Clearly, the cash held on balance sheet and cash flow, like technical cash flow, I think has been a constraint, which I think is pretty clear with how this is written. But the fact that they give 0 credit for the actual capital that they're is sitting on their balance sheet, it seems insane, because really the Bitcoin is the backstop for any of these instruments. Like, will they sell their Bitcoin? The preference would be not to sell the Bitcoin. You do everything in your power to pay the dividend or pay a maturity before you would sell the Bitcoin, whether that's, take out a different type of loan or sell covered calls, utilize it in collateral in different form, try to post it as collateral and get a yield in a different location. Right. You would explore every option on the planet before you'd sell your Bitcoin to do that. So it's like Bitcoin is really the backstop of this whole thing. And really they're chopping off the excess risk and they're chopping off the excess return and delivering this product to different pools of capital that want it. So I think we're still incredibly early, right? Strategies has the same issuer credit rating as Chuck E. Cheese and JetBlue. Like you can't make it up, right? Like that's insane, right? You've got $70 billion of capital and you're getting the same rating as Chuck E. Cheese. Like,
and didn't the language on it kind of insinuate that they understand that he's going to keep stacking forever? And it was almost kind of like, we're going to continue to give you nothing the more you stack. So it's almost like, are they kind of giving an ultimatum or trying to, I don't know, insinuate that they should sell the Bitcoin or do something to generate capital? Or am I reading too much into that language?
Well, let's pull it up. Because they did give guidance, right? They said if they retired the convertible debt, that could result in an increased rating. Basically, they're not expecting a rating within the next 12 months, which I think is common, right? The rating agencies don't want to be seen as changing ratings significantly in any one direction. They did give them a stable rating, so I don't think there's going to be a downgrade at any point in the time. But really, this is a big like educational process for everybody, right? We're talking I think a lot to retail here during this podcast and what we talk about, but there's a huge educational process that needs to happen globally to capital providers, different rating agencies thinking about risk. You need to define risk, you need to shape risk, you need to calculate risk, you need to show the math and walk through it. It's early days. Let me pull it up.
I'm going to frame this. I'm going to frame this a little bit differently. If your job is to give a rating to traditional bonds based upon real estate and some structure that's been in place for 50 or 70 years, and then Strategy comes along and does this with Bitcoin, and it's been around for 16 years. If you give it a really good rating because of all the goodness that we just talked about, but the problem is you then have to compare it to the other ratings that you have. Yes. Can you liquidate $1 billion worth of real estate over the weekend? No. Can you transport real estate across the world? No. So when you do that comparison, any logical assumption is you have to then downgrade what you have on the other side in the physical world with something that's over here. So I think that the takeaway for this is that I don't think it's that we're early. I don't think they're allowed to make those changes, even if they could, because the $300 trillion bond market would rate down if you rate Bitcoin up. That's part of the problem, is that they're just not willing to do that yet. Now, you could say they're just stupid and don't get it. Or you could say they're smart enough to get it and they're just not allowed to do it. Or, I think that there's a combination that's going on there. I hate using the word stupid, but there comes a point where it's like you have to see this. And Jeff, I wanted to go on a quick tangent here. So when Blockbuster went out of business because Netflix put them out of business, we all knew that streaming was going to put Blockbuster out of business, except for Blockbuster. Blockbuster had $1 billion worth of bonds, and it was collateralized with DVDs and leaseholds. Why? How? I am not a good enough salesman to sell $1 billion worth of bonds backed up with DVDs. Having DVDs in inventory is like having $1 billion worth of bananas. If you can't sell it in 2 weeks, they're all worthless. And that's the same thing with the DVD. Once you watch a DVD, it went from being worth $20 to $1 at a flea market. How you could convince somebody, even if it's rated junk, to buy DVDs in a bond, breaks reality in 2010. This is not like old days. And so I think that that's part of the problem, is that they were able to sell junk and because it had a rating on it. And so when this happens, I think that when Strategy got a rating of B-, and finally when their prefs get a rating, it's pretty much going to rock it up. The only question that exists is how long does that take? Does that take 3 months, 6 months, or a year? That's the only question.
So are you saying that if they gave them a higher rating, that would be like an indictment on the rest of the bond market?
It would have
like
to
a rug
be.
pull on just everyone else?
It would be a rug pull, because then you would admit that real estate is not fungible. Real estate cannot be liquidated over a weekend. Look, if you do a real estate transaction, the best that you could do it if you pay all cash in California is approximately 14 days. Because you have to, go through all the paperwork to go do it. But you could sell $1 billion worth of Bitcoin in 10 minutes? You could do it in 10 seconds, and then it takes 10 seconds for the blocks to confirm it. It's 24/7. You would have to ascribe some value to that, which we all know. So I think that's the takeaway what I'm talking about. Like, why wouldn't they have to take a hit on the rest of the collateral?
Everything would have to get repriced.
Everything would have to get repriced.
So is it just more? Yeah, go ahead, Tim.
Just one, I think this is a huge point. Anytime I got a B-, I was pretty excited. Anytime I got a B-, I was through the roof. Yeah. That's actually pretty good.
Yeah. Did you ever get a triple B-?
I have to think back.
Yeah, I did a little grok fu, and nobody's gotten.
Go ahead. I want to chime in here. This guy Mike Placid. I get what you just said. You can't rate something you never sold. Think about the negative feedback loop here is if Saylor sold, right? Let's say he sold whatever, $100 million worth of Bitcoin just to spite the S&P and say, look, what you can check the price on in anywhere around the world in 24/7 to prove to you it's real. I have to sell it and potentially trigger a taxable gain to prove it to you it's real. And you know what I say to those people? They could kiss my ass. And you know why they could do that? I'm going to be clear about this. Is because I make money by holding Bitcoin or Bitcoin derivatives. And then when I have to live, I sell some of that and then I pay taxes. IRS has no problem with that. And then I have to check off the question on the top. Did you sell any digital assets this year? Yes. The IRS has no problem with that at all. But I got to convince the S&P 500 that this is real because I triggered a taxable event just to show you that it's real. They could kiss my ass.
Yeah, be on the lookout if Strategy changes their IRS withholdings to last in, last out. They can just, put the orange dot on, take the orange dot off, put it right back on the next week.
Right. That's like saying, oh, my house has a value. Let me tell you how preposterous what Mike Placid is saying. I'm going to beat up on him because by the way, if somebody ever wants to do a space with me, DM me, we'll do a space. We'll have 1,000 people on the call and you can answer questions. If I have a house and I live in it for 30 years and it appreciates, right? It doesn't have any value until I sell it. But it'd be better for me to give it to my kids after I die because they get the step up value in it, right? Everybody knows this. But I should sell it first to prove that it had value, me trigger the taxable event, and then give the cash to my kids? No, that's not what anybody does. It's not financial advice, but people don't do that. That's the whole idea behind
Buy, borrow, die.
With the step up value. You don't sell it and trigger the taxable event.
Yeah, buy, borrow, die. It's like the strategy of rich people.
Right. And you do that and you hand it off. And by the way, they have no problem doing the step up value and evaluating it. And then you look it up in Zillow. There's the value of a house. That's your step up value. And there it is. You move on with your life. So.
Yeah, I keep coming back to this like real estate perspective of like you've got this. I saw it on LinkedIn, which is just the classic place to see some stupid stuff. They were saying, well, Bitcoin doesn't have any yield, and they're like, real estate has yield. Well, real estate on its own does not have yield. Like if you just hold it and you don't do anything to it, it doesn't have any yield. You have to put energy into it. You've got to plant seeds and harvest the seeds and sell your produce. Or
Jeff, I'm gonna be a little bit more specific on this. Your real estate has no yield, no income yield if it's your primary residence. If your real estate is rented out, then it has a yield. A typical cap rate in California is less than 5%. All you have to do is ask any real estate guy, what's your cap rate, right? And it's typically always going to be under 10%. And now that assumes that the person on the top floor doesn't break the toilet and have it flood the one below, and then you got to pay to fix all this and have an insurance claim. Real estate, and you have to make sure the people pay you. So the idea behind this, and we can get into the prefs. If I've got Stretch and it's paying me a 10.25% coupon every year, and it's return of capital, and I don't pay taxes on it, right? But I got a 5% cap rate on a piece of real estate, and it's taxable. That doesn't sound like a lot of fun. It sounds like a lot of work to make a little bit of money. Am I missing something?
No, not at all. You kind of shifted to the other side of the table there. But right. I guess really what I was getting at is right. Bitcoin on its own, real estate on its own doesn't have any yield if it's not Correct. Doing anything. If you're not putting energy into it to get output out of it. Bitcoin on its own doesn't have any yield if you're not putting any energy into it to get any output out of it. Okay, now you've got a corporate balance sheet structure, and you've got all of this Bitcoin held in your balance sheet, and they're putting energy into it, risk management, and they're generating a yield off of it by selling securities.
Right.
They are harnessing the yield of the Bitcoin by selling securities. And that is like the same concept as putting energy into real estate, hiring somebody to rent it out and manage it and take care of it. Same concept. They're just doing it with risk management in designing and creating and selling a security.
I agree with that. I mean, it ultimately comes down to this idea of like BTC USD arbitrage, Kager arbitrage. If you think USD is ever declining in terms of Bitcoin, or if you think the inflation rate's higher than that, stated by core CPI, then that relative to Bitcoin's price appreciation is ever declining. So then the logical kind of coordination or interaction between a Bitcoin security and a USD security is that the USD security is melting relative to the Bitcoin forever. So I think that's the like big idea. But I mean, to subscribe to that ideology, I mean, you have to believe in Bitcoin. Like if you're saying Bitcoin's going to have a significantly higher than 10% CAGR into perpetuity, you're essentially saying it's going to be the top performing asset over the next 20 years, guaranteed. And that's a crazy statement for like a normie to wrap their heads around. You're saying it's going to smash the S&P. You're saying it's going to smash the NASDAQ. And I think most, credit agencies and just individuals in general aren't willing to accept that fact. But I think the really important and the best way to sell these sorts of pref securities to a potential investor is kind of what you say, Jeff. It's like, oh, well, they have 100 years of dividend payments. So even if the Kager arbitrage doesn't come to fruition, an investor may still want to purchase these securities because they're going to get the yield for the remainder of their lifetime, likely. And if that arbitrage Kager doesn't in fact manifest, doesn't work out, then the issuing corporation is taking that hit, that arbitrage hit. So I think it's a cool, strategy takes on the risk, so they get leverage on the BTC. The investor that buys the preferred securities get the over collateralization threshold. Like think about it, right? When a bank gets reserves, they go lend them out 10 to 1. Whatever the reserve ratio is about 10% for a bank. Whereas strategy is completely flipped. They're lending out, for example, or they're issuing credit against 20% of their stack. So it's extremely, extremely safe for the credit purchaser. And then, strategy is taking on the directional risk of the Bitcoin. So it's a good setup if you're a Bitcoin bull.
Yeah, it's hard to wrap your head around if you're a normie, for sure. For sure.
Yeah, and it just seems like a crazy bet that they're making because Bitcoin doesn't seem productive, right? Like in a lot of people's minds. I mean, I find myself falling into the same trap, and I think a lot of people do. Like the allure of a 1% return per quarter, right, from real estate, 2% per quarter in terms of rent in real estate it feels like it's productive, right? Whereas Bitcoin's up and down and chopping and doing nothing, and it's brutal, and everyone TAs, and you feel like.
But it's directionally, what am I doing this right? It's directionally that way.
Exactly. And so if that's the case, then it feels a lot worse, but you're actually getting a much higher return than you would be with any of those stable sort of yielding products. So that's why it's hard for people to wrap their mind around, I think.
And the really fascinating part with the real estate comparison too is most people, people hold real estate for yield, but the wealthy people hold real estate for the store of value. Right. They're holding it for the store of value. Like if you're holding large pieces of real estate or large plots of land, or, they're holding it for the store of value and the capital appreciation, like the leveraged capital appreciation. The yield is a much smaller component of that. They're holding it to store their value for a long time horizon, right? Like there's a reason a lot of the real estate, like prime real estate, doesn't turn over. It's very illiquid. They are holding prime real estate to store their value there.
So
what is it going to? Yeah, go ahead, Mike.
Yeah, I'm going to chime in on this. From where I live, there's a very large tower that's probably 40 years old. And I took a picture of it in December, and then I took another picture of it just recently, put the two pictures side by side, and I told it what the dates were in both pictures. And I said, assume that if the blinds are drawn in both pictures 9 months apart, then that means nobody was in that apartment in 9 months. Because just statistically, how could that happen? And so in San Francisco, and that building's in Pack Heights. I'm not going to say where I live. That building is a prime piece of land at the top of a hill with a view of everything. And 40% of the building is empty. 40% of the blinds have not opened in 9 months. Now, why do people buy something that they would never live in it? And of course, they'll probably be somebody, oh, well, San Francisco is terrible. Well, they bought it as a store of value. But the problem is it's a 40-year-old building and the HO fees are probably pretty high on it now. So that became a store of value that nobody lived in it and may be hard to sell. So while it was probably a good idea when it was brand new, and Dan, you're now down, in Miami, there's a lot of condos that were bought as stores of value from people out of the country. People buy real estate because they think at some point in the future they could sell it for a higher price. And if you buy a marquee building, you're probably in good shape. But that marquee building 40 years later is a 40-year-old building. It decays. It needs new elevators. It needs a new roof. It needs a new pool. And so that,
And not to mention, Gran, like all the systems in place to borrow from banks to purchase the real estate itself, right? Like
yeah.
for you, you don't want to sell your equity holdings, but you want to start transferring them into a real estate asset. You can take a mortgage out and start paying it down over time, harvest tax losses, do whatever you need to do. So yeah, to your point.
Right. So they built this whole ecosystem around real estate. Basically, that was a decision right after World War II to have families buy homes. The government made that. How did the government subsidize real estate? They made your primary residence the mortgage interest deductible. They put a cap on it, But anyway, with that said, they made it so people can go buy homes. But, if you look at it as a rental market compared to buying a virtual asset, those are two completely different beasts. And for some reason, something that we see as simple, other people see it as difficult.
It's crazy to me that even with all of the tax benefits, mortgage interest deduction, 1031 exchange, that was
right.
The holding Bitcoin and these Bitcoin yielding instruments are still outperforming any real estate holdings, which I think is pretty fascinating. But one thing I think I kind of want to shift to here is talking about just the labor markets a little bit. Right. Amazon just announced they're laying off 30,000 jobs. And I think those are corporate jobs. Amazon's got like 1.5 million employees, but 350,000 of those employees are corporate employees. So I think it's nearly like 8 or 9% of their corporate employees are getting laid off across different sectors within the business that seem susceptible to AI. Now, granted, some of this is probably from overhiring during like COVID era, but it's pretty hard to ignore getting rid of 30,000 productive corporate white collar employees. And, a lot of people have provided the feedback for strategy that they should acquire a cash flowing business. They've got to focus on their cash flow. And Mike, we'll roll into return of capital here. But what cash flows are safe 10 years from now?
I wanted
people are expensive, right? People are incredibly expensive. You've got to have health insurance for them. You've got to buy liability insurance. They're like moving around. They're inefficient. You've got AI that's taking over jobs and moving around these days. So like really what cash flows are safe?
Yeah, Jeff, I wanted to talk about that for a second because we had talked about this earlier in the week. So for the people that don't know, we have a prep call on this. So before we do these calls on Wednesday nights, we talk about this. And so I do talk to Jeff. And so basically what happened is Elon Musk did a tweet about Grokpedia. Grokpedia is an AI-enabled Wikipedia. So I basically tweeted about this, that basically the value of Wikipedia dropped 50% from one tweet. And I put that in the chat GPT and it said, you can't make that claim. And I said, no, you're not understanding what happened here. I said, if you're Wikipedia relies on an army of people, volunteers, to manually go in and update everything over the course of 15 years or 20 years, however long they've been doing this. If that's been automated by a robot and you weren't getting paid for it, and the robot can do it 1,000x faster than you, and everything can be replicated through AI, the guy, Jimmy Wales, that's running Wikipedia, they asked him about this. It's literally the Blockbuster playbook. Oh, we don't think that movies are going to be delivered over the internet. How does the internet work? People drive in and go get their VCR or their DVD. And he doesn't think this is a threat. So one of the things by me being a tech guy out here in Silicon Valley is a term creative destruction. For the creator, right? Grokpedia by Elon Musk. That's the creative part. What did it destroy? Wikipedia. Jeff, when I talked about this with you, What was you're like, did this feel like, the old days of the internet bubble? That's what you said to me because I'm the
Yeah.
old guy. I get it. I said, and then you're like, and then you told me a story about how you used to do your book reports. How did you do
Oh
your
yeah,
book reports?
I had the Encarta like the CD-ROMs that I plug into my computer, and now it's Wikipedia is on the internet, and then Grokpedia just eviscerates. Like
Right.
I went in and I typed in Christopher Columbus, and it was just like everything you could ever want.
Right. So this
your
is where we
feet.
get to the cash flowing businesses. So they used to print encyclopedias. I saw those. My parents bought one when I was probably 5 years old. They were printed versions of it. Then it went to CDs and DVDs. And then it went to Wikipedia online. And now you guys are going to watch in a business. When we talk about the old days, there used to be Sears. There used to be these massive stores. It was an anchor tenant of real estate. Sears would be there. Amazon put them out of business. Done. You guys are going to watch Elon Musk eviscerate Wikipedia, and they're not even going to be aware of it. My question to you is, if you could use Google or AI to look up something on the internet, which do you guys prefer to use right now?
I don't even use Google anymore.
I don't use Google anymore.
I
either.
instantly I go to Perplexity or I go to ChatGPT, and it's just I let it do the Googling for me.
Yep.
It's just like totally insane. It's so efficient.
So Jeff, going back to your cash flowing business, this is where Saylor said, back in the old days in 2020, they had whatever, $400 million in cash. They're like, well, we had treasuries. We could buy gold. That didn't seem to be going anywhere. They could have bought real estate, but that was during COVID. So basically all real estate was repriced down to being worthless because everybody can effectively work remotely. So commercial real estate got crushed. So it's like, what does he put his money into? And that was the aha moment for him, was Bitcoin, and then the path that he's on. So I think that what we've seen here is that go buy a cash flowing business. That's a lot easier said than done for something that's going to have some staying power.
Yeah, there's only a handful of companies that have net incomes that are going up and to the right in Bitcoin terms as well. Everything else is going down and to the right in Bitcoin terms. So what's more efficient? Also crazy news today. NVIDIA is now a $5 trillion company. 4 months ago, it was a $4 trillion company. It was the first $4 trillion company. So yeah, I mean, this stuff is NVIDIA is one of the companies with cash flowing business that is outperforming Bitcoin. It's actually going up and to the right in Bitcoin terms, but it's one of the few.
Yeah, it's pretty nuts when you look at the broader market. There was a Kobayashi letter today. Grant and I were talking about it earlier today on the outperformance of the Mag 7 recently compared to the S&P 500 493. And it's at the widest spread it's been in almost 40 years.
Wow.
So what that tells you is pretty much all the other companies aren't performing. If you look at like all the macroeconomic indicators, the services and manufacturing PMIs, and just, general performance of the Russell 2000, which I think is about to break out, but it's just a story of underperformance. So I think when you look across the broader landscape of like what to invest in, you've got Mag 7, which have been doing quite well. Then you have Bitcoin, which has also been doing quite well, and you've got gold. So there's like debasement, and there's productivity in a very select pocket of the economy that's generating shareholder value, and that is AI, right? So I think that story continues to become deflationary pressures across the equities market. So you got to pick the winners in the equities market. Like
you got to pick the winners.
You have to pick the winners, and like right now, obviously, you can buy the semiconductor ETFs. There's a lot of different winners related to AI that you may be able to pick in the short term, but in the long term, I think picking those winners is going to be like extremely, extremely difficult. So you're going to probably want to be on the debasement trade. And I think that's something people are going to have to be okay with Bitcoin moving forward is like, I kind of prescribe to like a power law growth trajectory. And that's essentially a 38 CAGR going down to a 20 CAGR in 15 to 20 years. And those aren't like, that's pretty boring. Like when you actually get 30 CAGR, like it doesn't go up a lot. That's on average. What is that? That's like that's like 0.5% a week on average. So like, that's not a lot. And in terms of like volatility. So I think people are going to have to start getting used to that and get back to that kind of long-term thinking, especially moving forward, because clearly the booms and busts aren't behaving the same way they used to.
Hey, Dan, did you see the nonprofit that's going to go out at $1 trillion valuation?
Insane. Yeah. That's pretty insane. That's
anything AI is just like,
Well,
yeah, you just touch it with a match, it lights on fire.
So-
I think someone tweeted it was like the bull market's not over until OpenAI goes public. I'm like, yeah, that's true.
that's probably
Keep
true.
your levered longs in Nvidia until it goes public.
Yeah. The one thing I also think about here is like what how do people make, if AI is really successful and continues to eviscerate white collar jobs, well, like where do these people go, right? Like, so I was talking to my wife. She's a biotech recruiter, and she's seeing like a bunch of these people that she's tried to hire, and they've like never had a hard time getting jobs. Now they've been without jobs for like 6 months, and they're really struggling to find other places because any of these other companies that have also done layoffs, they're like, well, I'm not hiring anybody right now. I don't need to hire anybody because I've got all this AI. So like you've got all of this productive workforce that might just be sitting twiddling their thumbs, and there's nobody that wants to hire them.
I have a strong theory on that. Well, one, you've got remarks from Powell today that are essentially saying AI is not the problem in the labor market. He's saying the problem in the labor market is that they're cautious about inflation, so the labor market's right where it should be with their monetary easing policy, which is complete fucking nonsense. It's complete nonsense.
Yeah.
So that's
So-
you got that on one hand. We can recap those announcements today a bit, but so that's complete nonsense. He was hawkish during the entire meeting today. Cuts are at a 95% probability of a 25 basis point cut in December. They were before the meeting, and he essentially came out and said, they're not guaranteed. I think we're still going to get the cuts, but he's saying the upside risk to inflation is still there because of tariffs, right? Because of tariffs. Clearly, inflation has been ticking down ever since we had the tariff pressures. This has been sticky inflation since 2021. But on top of that, the AI thing is completely real. The jobs market's weak during a booming CapEx spend on AI because no one's hiring, right? And layoffs haven't. You can look at both the non-farm payrolls, but you can also look at the JOLTS jobs reports, which show the actual layoffs happening in the economy. What we can see is companies are starting to not hire as quickly as they have in the past, but they're also not firing yet. So that's why we're in this like weird little sticky situation where layoffs aren't occurring, but hiring's not happening. But I think once layoffs start happening, Powell's hand's going to be forced. So like I think there is definitely a narrative for 26 and beyond, especially with the ending of QT and then slow build to QE moving forward.
So Dan, I agree with all your macro indicators that you talked about, but I do want to talk something about the comments that are in here that are coming. The money printer will go out of control because there's nothing they can do to fix this if people are just out of work. And how printing money just helps people is a second order effect that doesn't really make a lot of sense based upon what we just said. So in the olden days, back during the internet bubble, or the way things are today is your future is utopia, meaning that it's going to be awesome and goodness if you're in that new class that knows how to have those new skills to get those new high-paying jobs. Your future is dystopia if you don't have the skills to get that. So what happened during the internet bubble, I realized it was a shift. And so I walked into a little internet company in Florida, said, I don't get what you're doing. And they had frame relay. DSL did not exist yet. And I learned that on one connection, you could have 500 computers connected into it. And you sell to businesses, and a T1 line is $5,000 a month for 1.5 megabits. I now get a gigabit to my house for $50. So think about how the math has changed in that, okay? Orders of magnitude. And so I signed up for that. So that job went from being paid $25 grand a year in Florida, within 6 months, I was making 125 grand in Silicon Valley, because once I had that skill set, understanding how to, work on a Unix terminal, learning how to configure a router, I had a skill set that was in demand. So I was able to pack up my crap, moved to California, and I've been there ever since. So I got the skill set. So every day I went to work like, wow, this is changing fast. This is awesome because I have the right skill set. But meanwhile, the people working at Rocky Mountain News in freaking Denver are out of jobs because newspapers were going bankrupt. It's not that the information or journalism went out of favor. It's just it changed the medium from printed paper to online, and those people got left behind. That's the destruction. The creative part was we saw this happening for a mile out, and so your view on the future is how this happens. The problem with AI is that it makes a person that knows how to use it 10 times more effective, and that literally wipes out 10 jobs. And Powell's not seeing. Do I think that Powell knows it? Yeah. Do I think he could say it? No.
Totally
He
agree.
can't.
Totally agree.
He can't say it.
He's
he
trying to
can't.
be being his fucking full on speech right before the thing.
Right before he does a post, he says to ChatGPT,
Yeah, exactly.
"What's Trump going to say when I say this?" And ChatGPT responds back as Trump. I mean, so look, guys, you have to be able to see this difference. What's going on? Am I the old guy? Yeah, but I just read the death certificate on Wikipedia. Creative destruction. You go watch this happen in real time. You'll hear about $1 trillion company that Tim just said that will go public, which is and it's a nonprofit, which is absurd, right?
Yeah.
Because once you have more than 1,000 employees, it can't be a nonprofit. So, and what I know what's going on about that is crazy. But I think that this is going to be highly disruptive. And the way that you look at your future is what group you're in. Fred Krueger said, right? He said, either you're going to own Bitcoin or AI stocks, or you're pretty much miserable. What was his quote? Or you're screwed.
Yeah, he said life. He kept saying that in Santa Monica. I think he had a really good perspective on that. It's like he's like, okay, yeah, maybe Bitcoin doesn't climb as high or as fast as people think, but he's like, the real risk is that if you don't own Bitcoin or some sort of AI related asset, life could be really, really bad.
Bad. Very
like,
bad.
Really bad.
Very bad.
And I think that's completely accurate. Like, I think he's not wrong there. And the way, and we've seen it in the existing economy, right? Asset owners are top 10% of earners, the majority of which their income is generated from asset appreciation, are driving the entire consumer spend across the economy. So like, that's only going to become exacerbated. Like this idea that we're going to get some sort of great recession reset, like productivity will continue to be exponential, whether or not the people are on board. The GDP will continue to climb with this circular AI spend that ultimately leads to deflation. But GDP is just going to be a representation of the money printing, like at some point.
Yeah.
So it's like all that shit's going on.
Yeah, if you need another reason to be bullish, all of the deflationary pressure caused by AI and all the other disruptive transformations that are happening has to be hidden by the system. So if we're getting exponential deflation, they have to print exponential amounts of money to hide it.
Exactly.
It's going to be insane. And I was rewatching this series by Tony Seba. It was called The Great Transformation. And it's not just AI. There's going to be transformations in transportation. We're going to get transportation as a service. There's going to be energy, battery, solar. The other ones I think were food. We're going to actually be able to create animal proteins the same way that we create insulin with yeast. And so there's just going to be tons and tons of disruptive sectors, and they're all going to feed each other. It's not like they're individual and they're additive. Mm-hmm. They're all like multiplying each other. It's going to be freaking insane. And Bitcoin is already the intersection of encryption, the internet, and proof of work. And so these Bitcoin treasury companies, like Strategy in particular, they're eating the bond market. So you've got Bitcoin, which is already an S-curve, and then Strategy is going to disrupt the bond market, which is another S-curve. So it's like S-curves on top of S-curves. And I know people are frustrated about the languishing price over the last year, but my thesis has really not changed, gotten stronger. And my investment horizon is the same as Bitcoin, right? No one has ever bought Bitcoin and lost money over 5 years. So if, 5 years from now, if I'm looking at the 5-year chart and, strategy is underperforming, I'll reevaluate then. But I'm not going to change my investment thesis over, the 1-year chart.
It's a mega trend on top of a mega trend.
Right.
And I think there's a real world, and this is something I've been struggling with a lot too. And because I'm trying to manage a book, and I fucking benchmark it against Bitcoin and against the S&P, able to beat Bitcoin these days, but that's not hard. Not beating the S&P, which is quite embarrassing because we've always joked like the S&P return is garbage compared to Bitcoin. But the point being is I think there's a real runway for the build out of AI over the next 5 years. But it's a Jordy Visser kind of style of thinking, and something I think about a lot too is like, okay, yes, but then once the corporations and the AIs are building things themselves, the cost of energy has been pushed down to zero, math has been solved, physics have been solved, lots of healthcare tech and biotech is being discovered, and diseases and drugs are being discovered by AI. Where is that profit flowing? And a lot of it may be owned by autonomous agents or corporations that own the autonomous agents, and it's going down and down and down in price. So where does the value flow? And then that's where the scarce asset jumps in. So I think Bitcoin has a high compound annual growth rate for a longer period of time than people are willing to assign to it. Like they want 50% CAGR for the next 5 years, but I think the real unlock of Bitcoin is that it's going to be 20% CAGR forever after 2030. And that's really where the investment unlocks freedom for a lot of people.
You guys see those Neo robots?
Oh, yeah.
Mm-mm.
Oh, man, they've been all over Twitter. I'm surprised. They're like robots that will do all of your household chores for you. They've got eyes, but they've got no mouth. And the videos are like them going to pick up your dishes and make your bed and do your laundry. And they live in your house for $20,000. You just like plug it in. It plugs itself in. And it's been funny seeing the memes that have come out of it. It's like the view when you don't pay your Neo subscription, and it's like the robot, like, look, you're laying on the ground and it's the robot looking above your head with a gun in its hand, it's creepy. It's super dystopian, but it's so true. I mean, yeah, it's
or $200
and then
$4.99 a month, which is just wild that it's already that cheap, and you would think the price is going to come down over time.
The funny thing is there's speculation that it's like a Theranos sort of thing. Like there's actually a human operating it in a different country, like just watching, like looking through the video camera and like
with a remote control.
Yeah, with like they've got things and picking stuff up.
Guys.
Oh, there it is. Yeah, tele operated. That's just crazy.
Look, I kind of get that I'm the dinosaur, but I will leave my house to go food shopping. I do it myself, and I go get my food and I bring it back to the house and I actually cook my own food. And you're like, what does this have to do with anything? Well, on the street that I might look through the window, and there's a tech worker across the street from me, and she has a monitor. I don't know how big it is. It's freaking like 4 feet wide. It's curved. She's got like joysticks and mice and mouse, whatever. She's like work. And I've talked to her. She's like she does whatever, some remote work. I think that she gets 2 meals a day delivered to her that she doesn't cook at all. I don't think she cooks. I see the little scooter shoot up and they drop the food there and they go get it. So she doesn't cook at all because she has no time to do it with her tech job. And I'm just like, she'll be the first person to go get a robot. And she has a Tesla and a self-driving car. And, people are like, I'm so busy in my job trying to make money that I don't get displaced by somebody else using AI better than me. And therefore I can't leave my desk to go do this and therefore I work as hard as I can. And so that's kind of like the weirdness of where we are right now. So do I think that we're going to have robots in the house pretty soon? Yeah. I don't, people buy the Roomba, the vacuum cleaner that goes by itself.
Mhm.
I'm like, I have a vacuum cleaner. I do it myself. It takes like 15 minutes. Not a big deal. But people buy those, these robot vacuum cleaners. So I think that this is going to happen faster than people think. And then you're going to have other people that are just like, Jesus, I'm just trying to buy eggs and food and get by. And that's the haves and the haves nots. Nothing, somebody was saying, well, you have this wealth gap. Right now, it's not going to change. Nothing's going to change. The
The
people that are on
robot.
this call, right? The people that are listening to us, the 13,000 people that are on, 19,000 people that are on this call, they're like, wow, we better go get some new skills or make enough money and go buy Bitcoin or Mag 7 stocks. No financial advice. But if the other 493 S&P 500 stocks are not performing, you basically have like 10 assets you could buy.
Yeah.
I think about this a lot, considering I'm kind of at the earlier part of my career. I'm 24, so I think a lot about like how can I position for these next 10 years and be set up in the best way possible. And I'll just give my thoughts on like what I've thought about by being in this kind of environment. I think you could be run a high end electrical company. I'm an electrical engineer by trade. So during this AI capex build out, Jensen Huang just made some statement. The millionaires of the next 5 to 10 years will be plumbers and electricians, right? What he's essentially saying is before embodied AI gets here, physical labor is still in demand, especially high skilled labor in a market where the white collar worker is being displaced. Okay, so that's like one thing. I also think an underrated sector is luxury goods. I think in a world of abundance, humans will still crave scarcity. Obviously, that's kind of the sales point on Bitcoin. But all the rich people are going to want to show all the other rich people that they're richer than them. So what are they going to buy? They're going to buy art that the other rich person can't buy, or they're going to buy sports cars, or they're going to buy watches, whatever it is. So I think somehow being well connected in that environment, brushing shoulders against very wealthy people who are only getting wealthier is likely a very good decision moving forward to protect yourself the next 10 years. And then finally, I mean, that's why I think actually Bitcoin credit is a really interesting space to work in. And that's why I've kind of chosen to be in this area. And I think why a lot of us have chosen to be here is because, capital markets and the structure of finance will change moving forward. And so positioning yourself in the middle of it is actually a great way to build a career moving forward. And doing, traditional finance and not being set up for that, I think it's going to be difficult.
So that's a good segue. Can we transit? We got some questions on what do you want to call it? Structured credit, digital credit.
Digital credit. Let's talk digital credit.
Graham, maybe lead us off. I know you've been
kick us off on digital credit. Great.
Digital credit.
DC with Diet Coke and digital credit. Over to you, Graham.
Okay. So digital credit. Look, I'll admit that I didn't understand something until yesterday. I didn't get something. I knew what return of capital was. I read the prospectus on Misty and IMST, and I read it the old-fashioned way. I actually read the documents, and you get to the juicy stuff about page 40. Now I'm much better at AI, given that was a year ago, that I could say, it's kind of hard to prompt for a term if you don't know a term to look for. But once you do this, so what didn't I understand? With Misty and IMST, you have return of capital, and the yield, according to the SEC, is a combination of return of capital combined with the gains on the derivatives that they have, the covered calls that they do. That's according to the SEC. According to the IRS, if they give you back your own capital, return of capital, that's not taxable. So the SEC and the IRS define yield two different ways. And I knew that, right? Then I saw Misty has, basically the price has eroded down over time. And I was thinking about buying this, and I had tweeted about this, 6-8 months ago. And a couple people reached out to me, very prominent people, and said, read the prospectus and then call me back. And I read the prospectus and I'm like, I don't like what I see in there. And they're like, well, you had to read it. So anyway, so when I looked at it, and somebody said to me, why don't I like MSTY? Somebody said, look at TLSY, the Tesla covered called. And if you look at TSLY, it's basically down.
Yeah.
And that had been trading much longer. And I'm like, well, that to me, that seems like a good indicator. So I never bought any, Misty. And I was like, this doesn't work good. That clouded my judgment for looking at the prefs, because once they announced that the prefs are going to be return of capital, I thought about those and I conflated two things together. Now thinking about this differently, specifically with Stretch, if it maintained, it came in at 90, it's whatever, 98, $99 today, whatever it is. And if that stays pegged at par, and it should, in my view, no financial advice here, it doesn't have that price erosion. And so that perspective is that when you get paid, it's 10.25%. Assume it's 10% to make the math easy. So you buy it for $100, and every year you get $10. After 10 years, your cost basis is zero. When you go to sell it, it's long-term capital gains. You pay 20% on the $100. Or what you do is you die, give it to your kids. The step up value goes to $100. Your kids don't ever pay taxes on the $100 that you did. And then they perceive to receive a 10%, assuming the coupon stays the same. I know it's 10.25, and they get that for the rest of their lives. So you just retired your second generation. Now, some people had said this, but it did not sink into my head. And I told Dan, earlier before this call, I wasn't getting it. And the other reason why I wasn't getting it, because I'm a large MSTR shareholder. In the short term, the coupons are paid out of the common stock ATM, which has put pressure on MSTR shares in the short term. To Jeff's point of view, if we educate these people that can buy a lot of bonds and shift to the prefs, that education, then they become self-funding based upon the inflows, and that changes the dynamics of where we are. So to sum this all up, I had a phone call, talked to a very important guy yesterday, changed my mind. That's where I am today. I won't say who he is. People could guess. And so from that view, I look at things differently today. And I think one of the most important things that you could do in life is to say, you know what? I thought I understood something a certain way at a high level, or you thought that you have a good understanding, and then you realize, you know what? I didn't get something. And I could admit that publicly, just like Tad Smith. He admitted that he didn't understand money until what? He was 56 years old, Tim?
Yeah.
Yep.
For a guy like that to admit that publicly, but he did, and then you change your mind. And so for me, it was a learning example. And so I say this publicly. So that really changed. Do I think that MSTR stock will be under pressure in the short term? Sure. Do I like that? No, I don't. Do I get the greater good of why we're here? Yes.
So this basically juices the yield. I highly encourage anybody, if you're still here and this is interesting to you, which I think it should be, go watch the Scott Melker 30-minute interview with Saylor, because he hits on this directly. And they effectively stumbled into digital capital. They've stumbled into digital credit, and now they've stumbled into this return of capital scenario, which is the reason it's able to be characterized as return of capital is because they are utilizing the ATM to pay the dividends. And because they are not, it's like basically a break-even operating business. To the extent that the operating business was really profitable, it wouldn't be considered return of capital. So because of that corporate structure, it's almost like a loophole, and that effectively juices the yield on any of these prefs even higher. So let's just say you're getting 10.25 on a tax adjusted basis, you're really getting like 17. Which you look at anything else in the market, and you're like, why on earth would I hold anything else in the market? We just spent 35 minutes talking about future cash flows of any of these companies and what they look like based on AI, unknown. And now you have a fully an over collateralized instrument that's harnessing the productivity of the asset and just this general market environment of AI and storing energy into the future. These things look incredibly attractive.
Yeah, so I'm gonna say so Jeff, I'm gonna say this a little bit differently. You know, some people are like, what happens if there's $3 trillion worth of these prefs? I'm like, look, it's $2.7 billion right now. Okay. And by the way, you know, if you watch the Scott Melker interview with Saylor, he said basically, oh, PFF, the BlackRock Preferred Shares Fund, bought
200 million.
2.2 million, yeah,
I
two
did it
million
too.
shares worth of $250 million worth of STRC. So of course I got a chat GPT to check it. And you know what? It's correct. They unload that. So sorry, they load up their CSV file of what's inside of it. So that's true. And supposedly all of the prefs are inside PFF, but I
Yes.
haven't been able to. Yeah, so they're all
That-
in there.
yeah.
That's a big deal. You know, the part what I want to say here is that, you know, if you, you know, one of the things like in life insurance policies, you know, there's a really high salesman fee that gets paid on those because they're hard to sell. With this, the sales fee is really zero on these prefs. But what I want to say is this, you know, if you're able to sell these prefs and you can sell it to somebody and they buy it, that's not a taxable event. Then what happens is you could sell MSTR common shares to pay that dividend. That is not a taxable event either. If strategy right now, the way that they can say that this is return of capital, right, is because strategy has structured it where where they've designed to make this where they're not running out of profit. That's where they get this with this return of capital. So you've got these three levers that are very tax efficient in order to roll this out. And so I don't think people are getting that. So right there, MSTR is
This is stretchy.
1.49%. That actually came up. So
Yep.
look, folks, it's there. There's the validation right there. The notional value, $218 million.
That's stretch.
That's right. That's
Then-
stretch.
And then on page 3, you've got Strife at 91 million. This is Strike at 88 million. And then the next page, you've got Stride at 74 million.
Right.
So you got all of them.
Yeah. So I want people to realize I'm reading the comments that are going on. People are like, this is just a Ponzi scheme. You know what? Then everything is a Ponzi scheme. You know, people say all the time that the only way you can make money in a stock that doesn't pay a dividend, right, is that you have to sell that stock to a bigger idiot than you. It's the greater fool theory. I bought a stock and it doesn't pay a dividend, so I get no yield. The only way I make money is sell it to somebody else that pays a higher price. That's the way. So it's speculative. All non-dividend paying stocks are subscribed to the greater fool theory. In this case, what I think that what strategy built with Saylor is digital credit. Did I get this basically before yesterday? I understood all the parts of it. I have a much different understanding of that today. And from that perspective, I think the short-term pain on MSTR outweighs the long-term objectives of where the prefs are going.
Yeah.
Jeff, does that make sense?
100%. And somebody said they couldn't support $3 trillion with the MSTR common ATM. I think that is just absolutely incorrect because the risk of the relative risk in these instruments right now is completely mispriced. At a future point in time when strategy is holding $3 trillion of this stuff, that means they probably have $6 to $9 trillion of assets on their balance sheet. I would assume at that point. So what's the common stock worth? A multiple of that? I don't know, like 10, 15 trillion. The numbers are a bit mind numbing, but the amount of liquidity that would be in that would be very, very high. It would be providing like liquidity for the entire market, kind of like Bitcoin is. So just this really, really deep liquidity pool. And these instruments would probably reprice lower. So I think about this a lot, just the risk. I've been doing a lot of research and development and advancement of like risk models around this stuff. And I keep saying risk is mispriced globally. And I think that's the like crux of this entire conversation is really getting anybody that's holding any instrument to think about what are the true risks of any of the things that they're holding. This kind of gets Soleil into like underwriting risk. my last 11 years, I've been underwriting risk for insurance companies, like identifying like how do I evaluate risk? Look at different things and selling different tranches of risk and talking about it. And I've now had just several conversations with people in the industry, and nobody can wrap their head, like nobody's really focused on the risk of these instruments. That like the instant thing that everybody likes to go to, this is on Twitter, this is in TradFi, is black swan downside. Like that's just the easy thing to go to. Like, oh, you didn't put a negative scenario in your BTC analysis. Well, if I assumed Bitcoin CAGR of 5% and a volatility of 50, that actually does assume significantly negative prices at any point in time. I'm like simulating and modeling this into the future. And this getting society to think about risk of these things relative to other things is going to just take so long. It's going to take so long. And it's not going to change until there's pain in other places, likely. So this is, other debt instruments underperforming, pension funds maybe not necessarily meeting their liabilities, or large pools of the population holding their or getting their pension checks or their retirement checks, and they're just not keeping up with inflation. They're losing purchasing power over time. I mean, I'm seeing this with my father-in-law literally in real life right now, and it's like kind of sad to see. And it's just I think that is just going to take a long time for people to shift perspective and start to think about the mathematics here. And you need AI, you need computing, you need a sophisticated pool to start accepting this stuff.
Yeah, and on that topic, Tim, go ahead.
Oh, sorry. Mike, when you were talking, and if, again, Saylor tax adjusted on the prefs because of return of capital, 16 to 20%, depending on what state you live in, that's like a private equity style return. Mike, you and I literally met because of like a private equity style fund where it was targeting 15 to 20%. So I literally just put into chat, what is the total market value of private equity? Well, according to S&P Global, the global private equity market was about 5.3 trillion in 2023. It's expected to reach about 6 trillion by the end of 2024. So maybe digital credit is the new private equity.
Bitcoin's coming for everything. Yeah, Bitcoin, it's really coming for everything.
Yeah, guys, I'm going to tell you something. I've met a lot of people that have 800 score in math SATs and Ivy League. I'm in Silicon Valley. People that are super coders, pretty commonplace here. One of the things they don't get is moving averages. So let's say your moving average is
like literally
is
math.
20% a year. Everybody's like, oh, that means it's 20, 20, 20, 20, and you stick that into your spreadsheet. Nah, moving average doesn't work like that, bro. What it means is I've got 40% one year, 0% the next year. The average is 20%. They're like, well, how do you know it's that? Well, it's whatever. It's an 80 vol. 80 vol, well, it's 40% up and down. You take the vol out, and then what happens is they just assume that it's a straight linear relationship, and it's not. So for moving averages for Tim, getting back to your 18%, if you want to average 18% a year after tax income, you need years where you get 36% to offset the years when you get 0. But if strategy is paying 10.25% and they don't make payments, if it's cumulative, Dan, jump in here when I make a mistake. They've got to keep up with that coupon that they promised. Now, did I think that it was rather unreasonable because they have to sell a lot of they have to sell some MSTR common shares to pay that coupon, and I own MSTR, so I don't like that dilution there. But back to your point, Tim, this 18% a year effective yield is huge. I mean, it's like, why invest in the S&P 500 if you get an effective non-taxable yield of 18%? It's 10% coupon, not paying taxes is equal, depending upon your tax bracket, 15 to 18%.
6x over collateralized with investor protection of cumulative
6x over
dividends
collateralized.
and a step up penalty in the there's so many investor protections in these things too. Like they had to sell them and get them off the ground.
That's
Like-
why I was freaked out about them, because I think they were adversarial to the common. Like I just, not adversarial, but the point being is they were so oriented towards the preferred holder. I mean, they still are.
Right, right. I want to address some of the comments that are coming through. Rock is just tax deferred. Yeah,
It's tax deferred. It's buy
till
borrow.
the point when you sell it. So
what
if you
do you-
keep
what
it
do you-
10 years, your
like, yeah,
cost basis is
tax
zero.
deferred. It's buy borrow die. What do you want?
Somebody's going to be like, well, you should go move to Dubai and you don't have to pay taxes. I'm like, well, I don't know anybody in Dubai.
I don't
So,
know.
you know,
British hodl.
right, right.
But,
So,
but yeah, that's a good point. I mean, the tax implications are massive. I think I personally am a little nervous. Like if let's say Stretch really takes off and starts eating the bond market, I don't know if the SEC is going to be cool with these things being continued to be taxes for return of capital. So that's something I'm looking out over the horizon. If it's in fact successful, I don't think you can count on that lasting forever. But that's just my 2 cents.
Even if they're not, they still whoop ass on everything.
Yeah, no,
Yeah.
totally.
Which is crazy. And to that point, Dan, and I want to tie it back to the S&P thing here, right? Like if Strategy has an investment grade rating on these things, they're going everywhere. They're going in every single fund. They're going in pension funds. They're going in IRAs. Like they're going everywhere. Insurance companies systemically, right? Too big to fail systemically. And that is like a huge, that is just so like the gravity of making that decision is so big. And I don't think they want to make that decision yet. Because
completely.
right, like if that's everywhere, then that's basically saying if this fails, like we're not going to let our society crumble. And right, like that's
I'm in agreement. I think it's
that's
smart.
what they're saying.
Yeah, I think them having a rating right now is like a massive step in the right direction.
100%.
Right? There are a lot of funds who are supposed to buy B- rated debt.
So I tweeted about this, but I'm going to tell the story quickly. Like if you want to buy unrated securities as an insurance company, you have to go through this just ridiculous process, right? You got to go to this securities valuation office. You got to file a memo. You got to send over the prospectus. You got to go back and forth with their team, answer questions. It's a 3 to 6 month process. And you got to pay a $5,000 fee annually on top of every security that you want to buy into the future. If you want to buy any rated security, all of that is gone. So like insurance companies are like, yeah, I'm literally never going to do this because I would literally have to hire people to do the administrative task to put the unrated security on my balance sheet that I already don't necessarily believe in. Yeah. Now, if you remove all of the friction, AKA a rating, then that capital is like, sure, I'll put some of that on my balance sheet. Like, why not? So that's just one anecdote in the insurance industry, and going from unrated to rated, and every step along the way, every step it goes higher is a new pocket of capital that opens up. Basically, like I'm viewing these as, well, you know, that open door meme, it's got the Grim Reaper and it's like different pools of capital. Like that's how I see this in my head. You got to go open another door and you go kill them and get in the door. That's kind of how these different pools of capital are, and these different ratings will probably be.
You know what's going to happen is at some point in the future, they're going to get rated. Whatever the rating is, it'll probably be lower than we want, and then eventually we'll ratchet up. And by the time Bitcoin is in the future, 3 years, 5 years, Bitcoin's at $250,000, $300,000, $400,000, and they get a rating. Somebody's going to be on, hey, what's the next new thing? Because I wasn't in on this. Stretch is only 90 days old, a little bit more. It was basically just announced in the last quarterly report and went live on the date. So the takeaway here is that Stretch is not even a little bit over 3 months old. So what's going to happen is we'll get an update tomorrow on what's going on. And I think you folks should watch the earnings report. The fact that, I don't know, what was on the last earnings report? 45,000 people. Wasn't that a crazy number? You know, we asked Tad about that, or there's a picture of, Metaplanet before and after they started the Bitcoin treasury. There was like 6 people in the room. 4 of them were with the company and 2 were like the people delivering coffee. Nobody wanted to hear anything about MetaPlanet. And then a year later, the room's got 500 people in it. So with that said, if there's 45,000 people on Strategy's call tomorrow, I think that's unprecedented. Maybe we should find out the metrics for how many people are on their call versus NVIDIA based upon the market cap. And I think you're going to find there's a much higher percentage of people on Strategy's call, based upon the market cap than NVIDIA. And I think that we live in unprecedented times.
That's signal, right?
That's the signal.
People per market cap on, right. Everybody's trying to figure these things out, and they're so new. And in order to figure them out, you have to spend time in doing them. And I literally work in this environment. I spend all of my time thinking about this. And anybody that's, focused on AI, most people don't even know Strategy exists. The company even exists. And meanwhile, we're running around like these are the greatest things since sliced bread, right? We've got just a lot of work to do.
Yeah, if I'm talking to somebody in the gym or the sauna or whatever about investing, and it comes, Strategy has to come up, and then I have to explain to them it's called Strategy, but the ticker's MSTR because it used to be called MicroStrategy, and they're just like, oh, okay, yeah, let me not care about this.
Talking to me in the sauna.
Exactly. It's either football or Bitcoin,
bro.
Yeah, fucking Ravens fans around here.
Jeff, I think, this digital credit, there's a lot of moving parts in it, and being able I think that the longer the person, the more that they have been in traditional finance, they're more resistant just to understanding it. There's a massive friction. Tim, what you just said, if private credit or private equity gets you whatever, 15% a year or 20% a year, and I could buy an instrument right now that does that after tax. I know it's return of capital. I think that they're like, well, that's too good to be true, so I'm not going to even listen to you. And so
that's exactly it.
Right.
It's too good to be true. It's too good to be true.
It's tax deferred. Okay. It's tax deferred.
Go ahead, Mike. Continue.
So real quick, I actually had a friend of mine text me and say, hey, I get it now. And you know what he sent me? He sent me an image. I don't know if we can pull it up, of like the pipe that's like the newest thing from Jesse.
Oh, yeah.
And
the siphon.
Of course, it's Matthew Montgomery, the oil guy, right? But it's like, he was like, I get it now, right? So it's like, I think that's part of the education curve, is like, give people something that they can actually see to help them visualize what's going on with all of these products. Mike, as you were saying, right? There's a lot going on there.
So Mike, to your point on this, too good to be true. I said this on, I think the hurdle rate, like I literally took right before I left in reinsurance, I was like, you know what, I'm going to give it one more shot. And originally I wanted to bring Bitcoin into the reinsurance markets. And I thought, look, I'm going to go make a good pitch. I'm a pretty good salesman in selling these structured products. I'm going to go talk to my CEO about Bitcoin and tell him I want to work on it. I walk in the door and I bring in the 4-year compound annual growth rate chart and the Bitcoin log Bitcoin chart. And then also a chart of other technologies and their adoption rates. And we talked about it for, I don't know, 10 minutes, 15 minutes. And I was pretty nervous. I'm like, I'm literally putting my entire career on the line here. And he's like, well, when I look at this chart, this seems sketchy. And it was just like too good to be true. This is the CEO of the company, like a multi-billion-dollar company that works in finance. And, I seem like the crazy guy. I seem like the churchgoer, like, let me tell you about my Lord and Savior, Jesus Christ, right? Like that's kind of what it came across as. But my initial reaction was like, I can underwrite this. Like, this is all of these elements is creating a risk profile that I can underwrite, which at the time Strategy was coming out with the convertible bonds. And I was starting to see it, like visions of underwriting tranches of risk. And it's just going to take so much time for people to wrap their head around it because it's novel. But there are new products that are really starting to do the same thing, and they're starting to take off. And I saw it yesterday. It's a fixed income product, and it's long Tesla, Nvidia, and Meta, I think. And it takes the like worst performance of the three over a 4-year period, and it kicks off a dividend. I'll have to find it and send it out to you guys. It was totally fast. I'll see if I can look it up if you guys want to keep the conversation going. But
something that happens. I was on a space a couple of days ago, and there was a guy that came on. It was Gary and Grant Cardone running the space, and this guy was saying, it's the same tired old trope about Bitcoin. I'll believe in Bitcoin when I can go buy a coffee at my local pub. The guy was British, and he's saying this, and I'm like,
That's my
really?
brother-in-law. Same way.
I'm like, so you know what I say to those guys? I'm like, okay, you know what? Go take a stock certificate down and go buy a beer with it. You can't use a stock certificate to buy it. You don't even have a stock certificate. I said, take a $20 gold piece. Now that $20 gold piece is worth whatever the price of gold is, but it's stamped $20. So that's all it's worth. Were they going to file off some of the gold? So I can't use gold to go buy a cup of what do you call it? And they're like, well, it's a digital asset. Well, what does that mean? Well, there's music portfolios. Can't touch music. You can hear it. You could see sheet music if it's printed, but those music portfolios have a value. Frickin' what's his name? Elvis Presley is worth more dead than he is alive because they license his name. The guy's not even here. So they license this. So when somebody tells me that I can't use Bitcoin to go buy something, I'm like, what's your point? You buy your asset, and at some point, either you borrow against it or you sell off a piece of it and you go live your life. And somebody's like, have I ever transacted in Bitcoin? Not really. Maybe once or twice to get a t-shirt at an event, but I would never do that. You know how bad I would feel if I used 2 Bitcoin to buy a t-shirt? Now that's an expensive t-shirt, right? So my takeaway is that we keep on hearing those same things. And the guy said this, and I'm watching the Jeremy Clarkson show. Like 80% of the pubs in the UK have closed down. You know what killed it? Social media. They're not going to the bar to drink. And Jeremy's like, well, we'll serve food also. And when he went to go get this license to go do this, because I'm a car nut, even though the show's not about cars, right? They're like, no, you can't set it up. We had 3 restaurants in here that all went bankrupt, out of business over the past 6 years. You're not going to be any better than them. So the way the world used to be changed. I didn't change it. It changed. So, lead follower, get out of the way. And, I think I'm pretty fired up today about this, Jeff. If you want to talk about something, just cut me off. But from my view, it's like, you know what? You better be prepared for the future. If you don't like the future, maybe you need to change your attitude.
I'll take the other side of that, Grant. I'd love every chance I get that I can spend some Bitcoin. I'm like so excited. I feel like a kid. When Tim took me to PubKey the first time, that was the first time I ever spent, Bitcoin, and a couple of double cheeseburgers, smash burgers, whatever the heck it was, Lightning, and I just hold open the code. The guy scans it, and then he walks away, and I'm like, did it work? You know what I mean? I was like, I don't know. And he's like, oh yeah, everything's good. And I'm being a little cheeky with it, but if you've got fiat to buy cheeseburgers, you're already Bitcoin poor. So I don't mind the spend and replace aspect of Bitcoin.
I think it's fun. Look, back in the old days in 2017, I would give, back when I got into it, whatever, $2,000, I was giving people, whatever it was, $10 or $20 worth of Bitcoin, and I was giving them full Litecoins at whatever they were back. I don't remember, $3 and whatever it went to. And I was giving them all kinds of stuff just to show them that it works. I will tell you that most of the people probably forgot how to get into Coinbase to go get it. So that experiment kind of didn't work the way I wanted it to. But I think our takeaway here right now is that we've talked about some very complex things. Prefs that are designed to sell by an operating company to attack the bond market. Tim, you're talking about the Jesse Myers with the little pipe showing how that all works is pretty awesome. For a visual, a picture's worth 1,000 words sometimes. And I think Clarkson's farm is totally underrated. By the way, the guy gets a Lamborghini tractor. It's like the worst tractor to get, although it sounds awesome. It looks cool, but they had lots of problems with it. But anyway, look, everybody likes to take us to task if we make any type of comment. You know, the 2 Bitcoin, on a muck there, you use 2 Bitcoin to buy 2 T-shirts. It's like, well, anybody that's transacted that way, you kind of feel bad 8 years later. So, or whatever dollar amount it was. And that's why I don't transact in it, because I think it's going up forever. And so from that perspective, I want to hold on to as much as I have. But what else do we want to talk about, guys?
I think I found the note, this the fixed income note. It's called a worst of fixed income note, and it uses NVIDIA. I think there are a few of these now, but they use stocks and they structure stock performance into fixed income to like reduce the risk and reduce the upside, which is the same thing that Strategy is doing with Bitcoin. They're like literally these structured notes are being created, wrapped around these equity products for people that aren't willing to take the equity risk, but they know that like if I hold NVIDIA or Tesla, I'm not getting paid a dividend, but I need some protections here. So they basically slam together performance of these equities and structure a fixed income product around it. It's just becoming fascinating. Like this stuff is just going to keep getting crazier.
But that's wild because every single one of those assets that are getting wrapped have disruption risk.
100%.
And Strategy has Bitcoin, which is impervious to disruption. It's the only thing that can't be disrupted is a Bitcoin balance sheet.
Right.
So it's an insane comparison.
Hey, you know what? I've got a quick financial engineering story here. It involves Warren Buffett and Apple. And you guys, anybody could fact check me on this, and it'll take 2 seconds. So, at some point, Tim Cook was running Apple. Apple had Steve Jobs had died, and he's sitting on whatever $100 billion in cash, and he didn't know what to do with it. So the internet lore is he wanted to know if he could talk to Warren Buffett, but he didn't know if he would take his call, whether or not it's true or not. So he calls up Warren Buffett, and they have a talk about this. And basically, what Warren Buffett said to him is, "You have all this cash; it's $100 billion. This is financial engineering at the best. If you believe that your stock is undervalued, the best thing that you could do is buy back your own shares." Because automatically it accretes value because it reduces the float and increases your earnings per share. Now, so Tim Cook hears that and he's like, "Oh my God, that actually makes sense." The interesting part about it was the downstream effects to Warren Buffett. Warren Buffett was one of the largest shareholders in Apple, not because he's a tech guy, it was because he brought in 2 guys that explained to him to do this. He had a large stack of Apple shares. So when he told Tim Cook to do this, right, it was benefiting Warren Buffett directly because they bought back their own shares, which means each share that Warren Buffett have is now a higher percentage of the market cap of the company. And this was a non-taxable event. Well, I mean, and so how do they fund these buybacks with Apple? A lot of the buybacks are funded by floating a bond. Why do they float a bond? Because a lot of the money is offshore. So the way they buy the shares in the US is they float a bond so they don't repatriate the dollars because they have to pay taxes on it. They float a bond. So Apple, sitting on $100 billion in cash, is floating a bond so they don't pay taxes to buy back their own shares to reduce the float to make more money. And everybody's like, well, we're cool with that. That's all good. Oh no, what Saylor's doing, that's financial engineering.
Ponzi scheme. Must be a Ponzi
It's a Ponzi scheme. It's not going to work. I mean, this is all going to, because he's doing it with balance sheet and Apple did it with the income statement. But the same financial engineering that Apple is doing with Tim Cook, nobody has a problem with that.
Yeah.
Well, and I know this is not Metaplanet True North, but I mean, they did announce that they might buy back some shares, right?
Metaplanet did 13.13% over the course of a year, and they pledged collateral for the Bitcoin to go do it. I think they need to do a couple other things. And if Dylan and Simon are watching this, guys could DM me. Dylan, you have my phone number. I've talked to him in person many times. But anyway, with that said, just give me a call. I have some ideas for you guys. And I think that what I just explained to you about financial engineering, any TradFi guy should know that. If they don't know that, then they don't grab a Diet Coke.
Jeff, so could you underwrite Bitcoin black swan insurance for a treasury company that was stacking?
Yeah, I think that absolutely could be a product in the market. 100%. You can calculate. I think well, really, I think the question is there anybody on the other side that wants to take that trade?
Mm-hmm.
Right. So, but you can certainly quantify the risk and start to structure the risk, and you're talking like tail out of. To put this in perspective, in the reinsurance world, I frequently sold very deep out of the money earthquake tail protection. So California Earthquake Authority exists. They've got billions of dollars of coverage. They buy, reinsurance up to 1 in 250 year return period. So if there was an event that was a 1 in 250 year event, like significantly worse than 1989 earthquake or like the 1908 earthquake, like double as bad as the 1908 earthquake in San Francisco, that product would kick in. And yeah, I think I sold it for like 4%. I sold $100 million for $4 million. $100 million of coverage for $4 million. But there's somebody that was willing to take on that risk to the downside, right? Like it's a tail event, but you have to be able to like wrap your head around what's the probability of that tail event and how do I quantify it? And I think you can. I think you can quantify those tail events, and I think you can quantify those things. Many people think you cannot, but I believe this is a structural instrument that is building and getting adoption. This is an adoption curve, not a speculative asset. And if you take that perspective, then yeah, you can underwrite it, and you can underwrite so you could sell that product to the market to somebody that's willing to take it on.
Yeah, when you tweeted, I can underwrite this, the only thing I could think of was that saying, when you're a hammer, everything looks like a nail. So apparently when you're an underwriter, everything looks like insurance.
Yeah, totally. And another takeaway that I've been having over time here is that there's basically one form in my mind of digital credit that will be pervasive and very viable in the future, and it's Bitcoin backed credit. It's very, very, very difficult to underwrite with any more certainty digital credit backed by Ethereum or Solana or any of these other cryptocurrencies that have a centralized authority. That you've got a new element that is unpredictable and difficult to quantify. There are convertible bonds that exist in the market, but for anybody like going to get Ethereum backed digital credit, the rates are going to have to be higher, right? Like they're going to have to be way high. There's going to be a credit spread between Bitcoin backed digital credit and Ethereum backed digital credit, which is in my bull thesis here is that Bitcoin's going to capture the credit market. It's not going to be any of these other shit coins because they're far more difficult to underwrite from a risk perspective. And Bitcoin being decentralized is much easier to wrap your head around that risk profile. So this is going to be a multi-trillion-dollar market.
So let me talk about Black Swan events. Black Swan events occur every single year. NVIDIA had a Black Swan event this year. Does anybody remember it? They signed the death certificate.
What happened to them?
DeepSeek came out. DeepSeek came out. I just Googled it, just ChatGPT. It comes up. Oh, NVIDIA has peaked. The AI boom is over. This AI startup in China was able to figure out how to use low cost or outdated NVIDIA chips to have orders of magnitude better than anything else. And Soleil, not to pick on you, we had a black swan event on Nvidia, which is now the most valuable company. How much is Nvidia worth, Jeff?
5 trillion.
$5 trillion. We had a black swan event on this year. So if we go back to the morons that wrote those articles in February, we go ask them, what do you think? Well, we thought the world was ending for Nvidia. And then remember the yen carry trade blew up last August. Oh, well, the freaking yen carry trade is over. Bitcoin's dead. So it seems like every year, Charlie Biello, who's on X, is awesome. He's got a chart, and every year it lists what caused the major dip to happen. So somebody could say is, well, if you don't own Nvidia, it's not a black swan event. But if you do, it is. It's a recession, when your neighbor loses a job. It's a depression when you lose your job.
Yeah.
And so your perspective is, if the yen carry trade blew up what you were doing or the price of Bitcoin, it's a black swan event. If you owned Nvidia, you had a black swan event earlier this year. If you got shaken out and then it went up, wow, I guess you didn't see that coming.
Yeah. I think you're kind of going back to that question a little bit. I think about often, like, what is risk? And in my opinion, risk is just math. It's probabilities, right? Like, let's think about the very first insurance contract that was ever created in 1686, the first ship that sailed across the Atlantic. There's a probability that that ship wasn't going to make it. And they said, I will insure your trip. You pay me this. And if the goods don't get there and get back, then I will make you whole. And that's just a probabilistic calculation. Like, risk has been in society like forever, and it's just been ingrained. Like gambling. Like, what is gambling? Gambling is risk taking. And you could boil risk taking down to probabilistic simulations and math. And now you have math money that is designed around math, and you can throw probabilistic simulations and probabilities around its future performance and create a risk curve for that instrument. And you can begin to structure and tranche different risk tranches based on anything, really. If you could think of it, you can create it. Like, and now you've got the use of AI, and like Saylor creating these instruments. He's out creating different risk tranches on all of these different things. But this is just the tip of the iceberg. Like, you can do 10,000 different ideas here. Like, everybody, there's been so much infighting on Bitcoiners yelling at Bitcoin treasury companies. They're all trending to one MNAV. It's like everybody's wasting so much energy when they should be focused on the bond market. Like, can we just all be on the same page here and focus on how shitty the entire bond market is? Like, just go look at a few things out there. Like, why does anybody buy these things? We need to turn a critical eye to those things, right? Like, a lot of like grifter mentality out here. People think that the Bitcoin treasury companies are grifting. No, like, we're trying to push Bitcoin adoption forward. And I would argue that Bitcoiners are probably the most trustworthy people on the planet, right? Any other shitcoiners, like, I'm not trusting any of those people. Like, trust is human nature. There's going to be trust structures in the future of society. Like, if society is going to be around, like, trust is going to be everywhere. Like, you're still going to have trust. Like, unless we're all computers, you cannot remove trust from society. So I think that's just always going to be around. But anyway, that's just my perspective.
Yeah. So, Dan, I think you put some research together. Do you want to talk about the 4-year cycle fallacy?
I just have some brief macro notes for
Okay.
your cycle fallacy we can discuss as a collective, I think.
Yeah, I think people in the comments are getting psyched about all the Bitcoin conversation, so this might be a good
Rip it.
topic.
Rip it.
Window.
While you're pulling that up, I'm super excited to see what it is, because I'm torn between like, everybody thinks they've got the 4-year cycle figured out, so then that means it can't be true. But then at the same time, Bitcoin's never existed before, so maybe it's just mathematically programmed to do it that way. So I can't even decide for myself what to think
It's like
about it.
liquidity environments, business cycles, right? There's just a lot of it's like not going to operate on a like
Well, people are suspecting that it would work on the, be related to the halving, right? But I think some people are coming to believe that it's not specifically halving related. Inception.
Yeah. I mean, to start, I think a lot of the pain people have been feeling has been the underperformance relative to QQQ, but it's really nothing too bad. It's just been going on for 3 months. But, we're still up big. In QQQ, I just did an analysis the other day. I mean, not analysis, I just looked through the index. I mean, 70% of QQQ is the Mag 8. So that's just something for people to consider. QQQ is not really an index. It's the Mag 7, essentially. Manufacturing PMIs, we've been in this period where like this has contributed to the underperformance of the S&P 493. Like everything that's not mega cap tech AI is underperforming, and Bitcoin is trending along with it. And that's a function of the business cycle. So this has just been a super weird period of time. Maybe AI CapEx spend makes this trend higher, but I think anyone calling for like a 70% decline in Bitcoin is just like a fool right now. We may not get that crazy rip people are expecting, like 200K in a short period of time, but like I think fading this and like getting short Bitcoin here is just ridiculous. This one's pretty interesting, actually. Average returns by Bitcoin cycle phase. So, and you've got Bitcoin, QQQ, SPY, and gold, right? The four big drivers or big indicators of kind of the macroeconomic trends. So in bear markets over the past 4 years, on average, every single asset has been negative. So the QQQs, SPY, and gold actually during these Bitcoin bear markets. This is a four like portions of the cycle: bear market, recovery, bull, and then bull peak. But you can see these assets are highly, highly correlated in every single market. So like a bet that the Bitcoin 4-year cycle will continue is essentially a bet that QQQ and SPY will be negative next year. And that's hard to foresee considering it's just AI CapEx spend. It seems to be going nowhere but higher, plus we're cutting rates into market all-time highs. And then again, this is during the last 3 Bitcoin bear markets, how have assets performed? So 2014 was a bit of an anomaly, but during 2018, 2022, you can see high correlation between QQQ and Bitcoin. I really think when you look back, the 2022 bear market was far worse than the 2018 bear market in terms of like how far we deviated from the general trend and how subdued we were in price. And I think that obviously that was a function of global liquidity and the credit hiking cycle, the rate hiking cycle. And so it's reflected in the general indices as well. But I don't think now is the time to be, shying away. And then CMC fear greed, super low. And like I had, and volatility. Volatility has actually been slowly coming back into Bitcoin. It unfortunately has been to the downside recently. But I think volatility is at a good spot. This is all kind of peak here, but volatility is a good spot. I think it's healthy, but it's going to take longer, I think, for us to go higher, but it's all going to happen.
Yeah, showing those other equities going down during the Bitcoin bear markets, like if you're going to assume that Bitcoin went down because of a 4-year cycle, then you'd have to kind of assume that somehow Bitcoin's 4-year cycle dragged the other equities down with it. Like that would just be a weird coincidence.
Right.
So it does seem like
I don't think you can make that assumption, right? Like if anything, the other equities, like at that point in time, Bitcoin was, like a $1 trillion market cap in 2022. So yeah, Bitcoin's not leading equities, right?
Right.
Following equities.
Yeah. All right.
So,
go ahead, Mike.
Yeah. So a little different take. Let's just say we look 2016. It just happens that Bitcoin halvings kind of correspond to U.S. election years by coincidence. So 2016 was an election year. 2017 was the peak. 2016 was election year and a halving year. 2020 was a halving year and election year. 2021 was the peak. It had a double top. we had an election year last year. Bitcoin went way up. It did really well. And then we hit a peak in this year. The question is, does that happen the year after? Is there a crypto winter? I agree with Dan said, given where we are with the ISM, cutting interest rates, I think that we're in a different phase this cycle. So I think that you have this exuberance that when a new political party comes in, people are like, well, things are going to be different. Whether it's you wanted the person or not, things will be different. And we're optimistic. Basically a year and a half after that, we have midterm elections next year. I think they're going to cut rates. I think that's going to happen. So I think next year we will have this AI, continue to have the CapEx AI build out, everything that we discussed. And so I think we're in a different cycle. 2020 was also a COVID year. So that was pretty miserable how it ground the price down. And so that cycle is a little bit weird. Somebody had mentioned before about the money printer. Since 2000 in the US, the M2 has gone up an average of 6.5%. If you probably take out the 2020 peak in 2021, it would probably drop it to a lower number. But you take M2 at 6.5%, combine it with inflation at 3%, which is probably more, that gets you your debasement value on the currency. And so basically at 10%, every 7.2 years, you lose half your value. So we should all be able to say that. So I think the takeaway from here is that, if a black swan event will happen every single year, do I think we're going to have one in the future? Probably within a year. I don't know what it's going to be, but I think next year with cutting rates, I think it's going to be different than what it was in 2022 and 2019. I think those years are going to be different next year. I think next year, Bitcoin is big enough now, $2 trillion plus asset, where it just operates differently. It truly does. Spot Bitcoin ETFs. And I just think it's different.
So Fed dropped interest rates. I think it's Elliott is mentioning credit expansion, right? So I think credit expansion is a worthy topic to kind of get out there. As interest rates drop and more people take out loans, it's like leverage in the system, like systemically expands, right? Like that money isn't really, it's just kind of created out of thin air. You've got increased credit being delivered to the entire market. Those people are now operating within the system with more money, more leverage taking on. And one thing that was just really fascinating, I'm still trying to wrap my head around it, and I can't really speak too much on it today, but interest rates dropped, 25 basis points, and treasuries ripped. It was counterintuitive. It went backwards from what I thought would happen. Dan, I don't know if you've seen this or looked into this really, but which to me, I think signals the 10-year went up, the 5-year went up.
10-year after that, yeah. It's because he was hawkish about the December cut, is what
because of inflation.
Yeah, exactly.
Which
that's just how the traders are trading it, right?
I guess.
But I think the 10-year, like there are a lot of smart people out there that are just saying it's like a lot of people are thinking like, oh, rates are going to come down on the long end, but like there's no reason for rates to come down on the long end with deficits blowing out as high as they are. It's just like, right. Long end rates probably aren't going to come down, even if they drop the Fed funds to 2.7 by the end of 26. Like the 10-year will probably still be at 4, but Fed funds could be at 2.7. And risk extreme higher.
Yeah. So then, like, how do credit spreads? Like, what pegs credit spreads? Is it the
Strife is pegged to like a 10 or a 30-year because it's like infinite duration.
Yeah, I'm not even thinking about the.
You just match duration and then keep going, right? That's how I always do.
So then, what's the point of the Fed funds rate? The ability to borrow.
Fed funds rate sets short-term duration. Sure, I mean it's how they manage short-term duration.
It's like the short term.
Whereas like the market sets the longer end of the curve, right? So like a credit spread relative. So like Strife, which is a perpetuity, its credit spread could typically be priced against the 10-year. 10 years at like 4.9. It's at 4.09% after the Fed meeting, up 9 basis points. You benchmark Strife's yield relative to the 10-year, whereas you benchmark Stretch's yield relative to, a 30-day T-bill.
Hey, have you guys ever met a rich bond trader?
I've never met.
I've heard they exist, but usually they manage someone else's money.
I feel
I
like
heard
bond
they
traders are
exist
now
also.
equity traders. Like the rich bond traders are now equity traders.
Yeah, Josh Mandel.
Yeah, Raul Paul, going off on this, but I'm gonna drop off. But I want to thank you guys, for the past 2 hours to be on this, and I think the key takeaway for this is that from my perspective is that with new information and new insight, when you think about things, you could change your mind, and sometimes with you have to be open to listening to those things. I think that's critically important. Talk to people that have greater insight, and I think it's okay to admit that you change your mind about something based upon new information. If anybody ever says, well, you said this 3 months ago, 6 months, a year ago, you're like, well, I have a lot of new information in the 6 months or 1 year, and it makes sense. And sometimes I learn better by comparison. If I compare something against something else, it makes more sense to me. And other people, whatever, if you just think about it enough, it'll make sense. I mean, that's just the way, you do those comparisons. So with that, I think this was, great call. Jeff, we're going to do this every Wednesday going forward.
Maybe we're still working through general schedule, but I think it'll be a little bit more scheduled. We'll have some changes in 2026, but yeah, we're going to still keep plowing through.
Awesome. Good night, guys. Thank you.
All right. I think we covered everything on the agenda that we're going to cover. Do you want to do some final thoughts? Jeff, you want to start it off?
Yeah, I will start it off. Everything, there's risk everywhere in the world. How you handle that risk is how you can quantify it and wrap your head around it. And Bitcoin can be underwritten. That's all I got.
Love it. Tim, you want to go?
Yeah. Maybe we'll cover this another time, but I've been trying to think through the 3, 4, however many things that are like the most important for Bitcoin treasury companies, and just rattling down the list. It's like social media, right? Call it digital distribution, AI, energy, capital markets, and one that I don't think gets a lot of attention yet, which is regulatory arbitrage, right? Where you're kind of, what are the rules here versus there? So those are my final thoughts.
Cool. Mike, I guess you're signing off, but we're all signing off. What do you got?
That was it. I already gave my closing remarks. Thank you, guys.
Yes, sir. Go ahead, Dan.
It's been a good convo, guys. Always fun.
Sure. All right. I'll kick it off with this. So back to disruption. One of my favorite quotes from the Dan Seba Great Transformation series was, "A butterfly is not a caterpillar with wings." And so if you're trying to predict what Bitcoin treasury companies will be based on what TradFi has been forever, you're going to be wrong. You just cannot slap wings on TradFi companies that own Bitcoin and think you know how to price them, you know what the direction they're going to go, you know what products they're going to offer. And so you have to wait for the phase change. They're going to go and they're going to go into a chrysalis, metamorphosize, and then you're going to get something completely different on the other end. So it's going to take some time, and I think the high time preference traders will probably get washed out, and the low time preference Bitcoiners will win out in the end. Appreciate everybody for tuning in, and we'll see you next time.